Welcome to Turning Hard Times to Good Times. I am your host, Jay Taylor, and I'm speaking to you, as I usually do, from New York City. This is June 18th, 2019. I want to thank each of you for listening to the show, making it one of the more popular shows in the Voice America Business Channel. I also want to invite you to keep your questions and comments coming along to questionsfortaylor@gmail.com. Questions, the number for taylor@gmail.com. We do need to thank our sponsors for this show, otherwise we would not be having this show, would not be talking to you now. Klondike Gold, Nuovo Resources, RN Resources, and Strike Point Gold are our current sponsors for Turning Hard Times into Good Times. Today's guests, Ronald Peter Stoffel, Quentin Henning, and Michael Oliver, all return. Peter and his colleague, Mark Valek, have published their 2019 annual In Gold We Trust report. It suggests that a world awash in debt is sitting on the edge of a disastrous financial abyss. As such, there are growing cries, at least from some people, for a return to an honest monetary system and an exit from the fiat counterfeit system that is responsible for a world heading towards another financial disaster. We'll ask Peter to explain the market and social dynamics that are driving this growing urge to return to honest money in the form of gold. As well, we want to know how the bankers and governments that profit from gold market manipulation through futures market trading are likely to respond. What are the market factors that may force a return to honest money despite objections of the status quo? And I'm really looking forward to speaking with Peter. So many things to talk to him about. It is a book that I think it's a free of charge book that you can order and download on the internet. We'll ask Peter how you might do that, but it's just, there's way too much to talk about today. I think we're going to have Peter back to address many of the topics that are in that 300-some page book. Dr. Quentin Henning will be with me after the first commercial break to update us on the progress of Nuovo Resources that they're making in Western Australia. Most importantly, I want to ask Quentin about the significance of the recently announced $30 million agreement with Sumitomo to be applied towards moving the Egina project towards production. Nuovo shares are way below their 2017 highs of around $8. That was in response to the initial discovery, the novelty of which has worn off. But the notion that the Pilbara Basin hosts another Witwatersrand-like gold deposit is still very much in play as the company now digs into the to establish the economics and the prospects for that gigantic conglomerate gold system that stretches for hundreds of kilometers. So really looking forward to hearing from Quentin and the latest, especially with regard to the agreement with Sumitomo, that world-class gold mining company that is now going to be working with Nuovo Resources. But right now, I'm really happy to tell you once again, we are so privileged to have Michael Oliver with us once again. And I would just urge you to jot down the website. It's olivermsa.com, olivermsa.com. Go there, learn more about Michael's service, and I think he probably has some free goodies there as well. But go there and take advantage of what Michael has to offer. You know, you're lucky to be able to listen to Michael's thoughts here free of charge. But if you really want to take advantage of what Michael has to offer, well, you know, you usually get what you pay for. And here, in this case, you get a little bit more than you pay for. Thanks for joining me again, Michael.
Hi, Jay. Good to be back.
Always good to have you. Michael, I want to start out today by passing along a question from a listener. A couple of days ago, a listener to this show sent the following message, and I quote, "I listened today to your latest interview with Michael Oliver, as I do every week. Some months ago, Michael suggested that after the downturn in gold, that it was going to be a major struggle to get back into the 1330 area. For some time, it went down to a 1280 range, and I thought Michael had made a mistake and seemed unwilling to own up to it. However, in thinking it over, maybe Michael was quite right, that it was going to be a struggle to get back over 1330, but be that as it may, it has returned, and an apology is now in order. We are now at 1335. As I said, this was written a few days ago. We're higher than that now. We are now at 1335, thereabouts, and again, struggling to rise up from there. I don't recall what he said or might have said to get from 1330 to 1360, but he did say in January that if we got through the 1360 area, it was going to rapidly move towards 1500. can you ask Michael if he still feels that way the next time you meet with him? So we're meeting with Michael now. What are your thoughts, Michael? Do you still see a $1,500 gold possibility if we get through that 1360 level?
Oh, yeah. It's a price chart level. All the momentum work that we do, long-term momentum, annual, quarterly, and so forth, has broken out. It's positive. It's already long been positive, starting in February 2016 when gold went through 1140. And then when we came up off the August lows of last year, which were down at 1161, we issued three separate buy signals, one at 1200, 1240, and 1280 on the way up. And the only thing left now is literally the technical breakout of the price charts. And this anybody can see if you get a weekly or a monthly price chart, go back to about 2014, and you will see all these rally highs that crested somewhere in the mid-1300s. It's almost a flat line. So it's a bleeding obvious structure, okay? Every asset manager in the world who's not in this market is looking at that line and realizes if it gets crossed, he's going to have to make a decision, be there or be out of it, one or the other. And so it's a very interesting price chart structure, and it's a valid one. It's not, a lot of price chart breakouts or fake outs. This one we view as a valid pending structure and one that should gush on the upside. We ran up quickly to it from our May low. Back in May, we were still grinding in the 1280s, 1290s. On the last day of the month, we had a number that we didn't think would be engaged until June, but it did it in the last hours of May and broke its monthly momentum out to the upside and gushed to the upside. We went from below 1300 to 1340, 50 in a matter of about 5 or 6 trading days. In fact, that was the most rapid ascent in gold in several years over such a short span of time. But once we got up there, we were overbought, especially if you reference short-term type indicators, including our momentum indicators, very short-term. So you were too hot to keep going, so it's best to pause. We did. Now, there was a day last week, I think it was last Friday, where we were up and we closed about $20 off the high. And I think somebody at that point said, there's another dumping by some manipulator. That's another popular issue out there among gold bugs, is that somebody's manipulating the market by dumping gold, especially in the night session, electronic session, massive quantities of contracts in order to control the market. And anybody who's been around these markets long enough knows that while that might be true, ultimately it doesn't halt reality. You might try to delay it, but ultimately, if you play that game, you're probably going to lose. And if you just pause and think about it for a minute, over the last several months of retrenchment, which was really the most modest gold retrenchment we've had of any of the highs that reached up into the mid-1300s of the last few years, this one was the most timid from February through May of this year. But there were a couple instances there where during the night session there was a dumping, apparently, of contracts. There, at least it felt to look like that. And it looked like somebody trying to manipulate it. But if you sit and think about it, if somebody sells gold futures, even if they sell them in a million ounces at once, okay, they either have to, one, be selling existing long contracts, that was taking profits on a prior long position, okay, which meant they bought it before they sold it, or they're initiating a short position. Now, if they initiate a short position, anybody who dumped into the gold market over the last 3 or 4 months of the retrenchment process and did it in one of those dramatic, intranight things, they're losers big time, unless they covered those short positions at some point. Because ultimately, if they shorted at all those given levels, which are well below us now, they're dead and buried. Because we're 1340, 1350, and a lot of those sales occurred in the high 1200s. So I feel sorry for those folks. And so if you're a conspiracy-oriented thinker, think again. Because if they did it and they didn't work, and ultimately it did not work, obviously, then those guys are hurting pretty bad. Or they were exiting a long position and have missed out on the upside. So either way, the guys who dumped the gold got hurt. Now, it takes me back to the late 70s. During the bull market from the 1976 low in gold to 1980, during especially 1978 and 9, the IMF was dumping gold in mass. In fact, they sold over 50 million ounces. Not a million ounces, 50 million ounces in repeated auctions that were scheduled, some unscheduled. And anyway, those initially had a negative impact on the gold market when they occurred. You would see the market would sell off. But after a while, those auctions, those dumpings of gold, had a zero impact. In fact, the gold market ate it up and just went right through there.
I remember that.
Okay, and we're talking quantity there, 50 million ounces, not a million. And it wasn't just future, it was real gold. Okay?
It was real gold, right.
Real gold, well, it doesn't matter. It's, it was real sales. They weren't conjuring it up. And yet the gold market ate it up and went from, $103.50, the August low of 1976, to $850 in 1980. So reality will prevail. And I feel sorry for anybody who might have dumped gold over the last 3 or 4 months of correction because they lost no matter which way they did it. So gold long should smile.
Yeah, my guess is that some of the major bankers probably were in there covering at the right time or close to it. But be that as it may, at longer term, you're right. If you held that position, you'd lose your fanny, wouldn't you?
Yeah. It wasn't very strategic. Anyway, so I'm very comfortable with gold. I think what we need to do now is maybe congest between now and the end of the quarter. Part of that conclusion we've come up with, and I could be wrong on that issue, we might go ahead and ramp ahead. The T-bonds look like they want to ramp ahead, and gold is in sort of the same category as bonds. It's an alternative investment. But the thing we're looking at is the dollar index, and the dollar index is poised, in our view, for a sharp downside. It's been dull for 10 to 11 months now, basically either side of 97 on the dollar index. We think that's about to end, and therefore that the foreign exchange markets, dollar and the euro inverse, are about to become noisy players in world asset categories. Yeah. And that would no doubt help gold, although we have to admit a firm or steady dollar since August of last year has not been an adverse impact on gold at all.
That's right. Gold has done very well. Michael, in about 30 seconds, what do you make of this, the relationship between the T-bond or the treasuries in general and the equity markets? I mean, normally we would expect yields to rise as equity prices rise, but in fact yields are collapsing. Which market has it right?
I think the T-bonds have it right for the moment, meaning we turned bullish on T-bonds in December last year at 141, and they're trading up in the 150s now, and we think they'll go to 160 probably at least. We're talking T-bond futures. It is an asset class shift. Sometimes T-bonds will rally sharply if there's a very sharp collapse in the stock market. That happened in late 2018, and recently in the May drop, the T-bonds took off again when the S&P dropped in May. But despite the S&P rally, the T-bonds won't give it up. And what that indicates to us is the flight to yield, even modest yield that you can get out of a 10-year or 30-year government bond, is solid. It's not impressed by a stock rally. There was the people who are buying bonds and moving out of stocks aren't saying, I better get back in stocks. No, they're persistent. And the T-bond action indicates that. And I think if the stock market rolls over again from whatever point, and by the way, the S&P right now, for those who are cheering and beating their chest about how great it is, it's all of about 1% higher than it was a year and a half ago.
Wow.
Go back and look at January 2018. We're 2882, okay? We were there yesterday.
Going nowhere fast. Going nowhere fast.
In other words, it's going nowhere fast, and that in itself says something,
All right. We'll have to leave it go at that, Michael. Thank you so much for your insights. Very valuable, very helpful. Thanks so much.
Thank you, Jay.